Let's welcome in our next guest. Mahantesh Sabarad is now joining us. Mahantesh, a lot has been spoken about earnings, what to expect going ahead. Say if the markets actually beat the Q4 earnings or the Q4 earnings beat the estimate with a good outlook, do you think the upside into this market could be very high?
Yeah, I think the market is poised in a positive manner. There's a lot of money that is riding on a host of stocks. So the moment you have huge amount of money backing the market, any outcome in terms of a result which is even slightly positive, and with a commentary that is talking of an outlook which is generally positive, would mean that you will see stocks getting re-rated. So we have reached a point in market where we are poised for a re-ration as a whole. Sector specific things might be different, but for the market as a whole, I think we are poised for a great rally ahead.
Right. So what do you think, markets do when there are earnings, when there is this sort of buoyancy, when people get the left out feeling? You think valuations have no meaning at that point of time?
So generally, people or investors tend to ignore valuations when there is a semblance of growth or an assurance of growth in earnings. So if you have a great business model and you have a semblance of earnings coming in, irrespective of what the growth rate is, it could be a 10% CAGR growth rate in earnings, or it could be a 25-50% CAGR growth rate in earnings. But the moment you have a near certainty of the earnings and the outlook is positive, valuations tend to be ignored. So you generally go in terms of valuation one notch higher. That's what the market is now poised to do.
Right. In terms of flow, so earlier, you had the DIIs buying continuously, FIIs were selling. Now FIIs are buying and DIIs are not selling to the same magnitude. So you just get a sense that they are booking profit. But if the earnings come, if actually they are higher than estimates, then both of them can buy and markets could see a very big liquidity plus the earnings rally.
Yeah, that is what essentially I was referring to when I was trying to tell you that why the market participants or investors tend to ignore valuations in a situation where there is a lot of money already committed and invested in the market, and therefore there is a collective buying momentum coming in. You tend to ignore valuations in favor of a phenomena that says earnings are bound to come. Unless and of course that structurally the businesses are bad and investors tend to ignore that particular business or business model, even if a short term, when I say short term, it could mean 6 to 12 months from an earnings outlook perspective, even a short term positive outlook would mean there would be a re-ration in stocks and they go higher. So liquidity, we will have a situation in market where there will be ample liquidity available.
Right. Do you think the biggest risk in the markets comes from US? What happens over there in terms of policies, in terms of Fed rate hike? That would be the only major risk to the market?
Yes, in a way. A couple of months back, if you had asked me the same question, I would have said yes. I still continue to maintain it is a yes. But then, what has happened is that with one Fed rate hike already over in this 2017 calendar year, the risks are that much lower. So 2 months back, there was this Fed rate hike related risk on the market, and it was, I would say, greater. Now it is still there, but it is to a lesser extent. Having said that, I think the major global risk that the markets will be observing is not really US related right now. It's right now related to what's happening in Europe and the upcoming French elections, French presidential elections. Any shock related to the election outcomes out there, which threatens the European Union bloc as a whole, will lead to a certain element of risk coming into the Indian markets.
Right. As far as global markets are concerned, you mentioned about French election or what's happening in terms of US policy. Last 5-6 years or since 2008, the focus has been only on central bankers and what are they doing. Do you think now it's shifting to policy makers and that is becoming the key market driver?
Maybe you're right, but then, let's take the example of Trump. You mentioned about central bank to policymakers is like a shift from Janet Yellen to a Trump. There has been a Trump rally in the US, and therefore globally also some element of rallies have happened in various asset classes. But having said that, this Trump phenomenon seems to be limited in terms of its repercussion. So it's probably a 6-month phenomena, or probably a 9-month phenomena, after which it will die down. But the central bank phenomena, who is far more wider and deeper, and the ramifications are felt for a couple of years more. So therefore, when I first tried to answer your question, I said Fed risk still exists. That means a rate hike which is not commensurate to the market expectations does impose a risk in the market, introduce a risk in the market, and therefore the markets can possibly go down. But the policymaker related shift in from the market's perspective is only a temporary phenomenon. So even by that logic, the French presidential elections will provide only a short-term reaction by the markets. It will fuel only a short-term reaction, not a long-term reaction.
Right. Let's talk about the commodity prices as well. So commodity prices have recovered from the low. But if commodity prices are where they are, or you don't see a lot of movement, actually these prices may be positive for earnings and flow into India?
So it's a very difficult question to answer, because when you talk of commodities, it could mean different. It could mean oil on one hand, it could mean metals on the other hand, and therefore it's quite different. When you talk of oil per se, with oil prices, if they generally rally or from the current levels, then it's not going to be good for the Indian markets from an earnings perspective. But what it does do is that it introduces an element of how risk. That there's an element of risk taking, money on the sidelines, which will come into the market. So the risk on trade, as they call it, will start growing. The net effect of the two is that the markets generally tend to rise. But if you look at the non-oil commodities, if there is any increase in non-oil commodities, then generally it means that the markets become subdued, because while some of the metal stocks or minerals related stocks tend to do well, the general market may not necessarily do well.
Right. Also, just let's talk about how the profile of the companies are within the top 200 names. So, you have a lot of companies which are having debt issues, but they have some assets, and you have a lot of companies which have free cash flow, or which are wanting to raise capital for better growth. Does that mean in FY 18-19, actually there may be a lot of M&A activity?
It's again a very difficult question to answer. M&A activity doesn't necessarily can be linked to the need for capital per se. M&A activities generally happen when valuations tend to stabilize. That means between the expectation of an investor of getting into a company at low valuation versus the seller, the recipient company wanting better valuations for its equity, if there is a balance coming in or equilibrium coming in, you will see a lot of M&A activity. Having said that, most of the M&A activities also are increasingly driven, not related to cash flow or debt solving kind of issues, but more M&A activities are simply targeted towards scale of growth. So there is someone who wants a greater scale of growth, and therefore there is an M&A activity. Look at the Idea Vodafone merger, for example. Okay, so while some may argue that they came together because there was a lot of debt on each of the company's balance sheet that needed to be resolved, but more importantly, it was about getting the scale right that drove the M&A. So we will see that kind of activity coming in, but the last comment on M&A is that when the market valuations become a little irrational, M&A activities should actually temper down.
Right, but in both the cases, you always see M&A activity picking up, right? So in the peak of the cycle, you may see some large cap M&A activity, or at the worst case where you said valuations are so tempted that people would arrange for cash and buy.
That's why I said it's a little difficult question to answer, but then the general observation is irrational valuations tend to mean tempered M&A activities.
Right. Let's talk about the NPA problem. That's one space which investors are worried about. But do you think there is an increasing expectation that some solution may come out? It may take some time, but do you believe that markets are expecting a solution towards the NPA problem?
So some of the NPA problems is getting solved in the natural course itself. So by virtue of a longer time that gets elapsed versus the favorable commodity price movements to general macroeconomic stability, all these factors contribute to better and stabler cash flows, and in such a situation NPA problems do not recur or do not occur, and as far as the past NPAs are concerned, some of them get upgraded and therefore they become standard assets. So we are going to see that natural momentum happening as far as the NPA resolution is concerned over the next course of fiscal year. But at the same time, there could be an element of push coming in either from the government side in terms of certain policy initiatives, including that we have been just hearing about in terms of the bad bank policy initiative, or it could also be addressed via the mechanism of raising of capital. The moment you raise fresh capital and bolster the capital of a bank, the NPA problem gets naturally resolved in the form of the ratio getting tempered down, mathematically speaking.
Right. In terms of NPA, if there is a solution, it's not only the banking space which will be in focus, but the entire market.
And I wouldn't say that the entire market gets affected by NPA resolution, but yes, the banking space being the heaviest contributor in terms of its weights in any of the indices, large indices, it generally would translate into a better index level. So if the NPA resolution happens, banks rise, and therefore a Nifty or a Sensex will therefore rise as well. But does it mean that because the NPA resolution you see valuation re-rating, let's say in a telecom stock or in an FMCG stock, then that phenomena may not occur.
Right. In terms of NPA resolution, at least one thing is sure, that once a resolution has happened, capex cycle or chances of capex cycle picking up would increase.
Yes, to answer your question in a very simple manner, yes, NPA problem resolution does mean that the capex cycle gets revived, but capex cycle revival is not contingent only upon receipt of funds. There are so many other things that need to be done in terms of preparation for the capex cycle. So there's a preparatory phase that the economy goes through for the next burst of capex, and that preparatory cycle has to do with demand conditions improving, with government policies becoming more leaner, and the processes becoming quicker. All these activities are happening right now as I see it in the background. A financial closure, that means receipt of commitments of funds, would naturally mean therefore the capex cycle resumption. So the signal that has to be read before the capex cycle resumes is, are the banks now willing to lend? Are the banks sufficiently capitalized to lend? Are the banks receiving sufficient projects, inquiries, so that lending activity begins? So these are some of the things that need to be observed.
Right. Can you also just talk to us about what's happening with the banking space? So let's start with ICICI Bank. Today we are getting news flow that Lombard, they may sell stake into Lombard, they may raise $1 billion. Earlier they have done something with ICICI Pru. Does this make the SOTP valuation of the banking side look very attractive for ICICI, especially considering others have rallied?
We have had similar instances in the past, in terms of the SOTP valuations looking up for many of these banks who have insurance businesses packed along with their overall banking business. But having said that, our general experience is that over a period of time, SOTP valuations do not materially transform the valuations for any of these banks. It's the valuation multiples improve only because of better visibility in the core banking business coming in, either in the form of expansion of NIMs and therefore better ROAs, resolution of NPAs, and so on and so forth. So SOTP valuation is to us seems to be only a temporary phenomenon. Yes, it does raise the expectation levels to some extent, but the euphoria dies down over the next couple of months or so.
Right. Let's just talk about also what's happening with PSU banking space. So something like SBI, say if the valuation of that insurance arm comes to be good, plus you have a little bit of solution provided or some clarity provided on the NPA side, then there is a lot of value in that bank.
Pankaj, I cannot comment on SBI.
Okay, sorry.
So I don't want to venture.
Right. So let's just talk about the PSU banking space, at least the big ones that are there. So if there is a solution which is taken for the NPA side, and there is some clarity provided, some of the large banks or a basket of large banks will tend to have some value because the retail franchise of these banks cannot be questioned.
Okay, NPA resolution is one part for banks, PSU banks to be re-rated. Why PSU banks? Even for that matter, some of the private banks as well. Okay, but having said that, I think the important issue here is that how well are these banks in terms of their capitalization. I think for us, when we look at banks, the single biggest factor that makes us look at a particular bank in terms of its investment outlook is what is the capitalization been, what has been the capitalization history. That tells you a lot about the bank. So more than the asset side, where the focus for most of the banking analysts, the focus is on the asset side. How good is the asset? What are the NPA levels? What is the investment book, and so on and so forth. We would rather focus on the capital side, because at the end of the day, most of these banks have a great history, have a solid franchise, unquestioned kind of branch presence network, and their ability to bounce back from that franchise strength. Provided the capital structure is right, provided the capital is strong. So I would tend to first look at the liability side for most of the banks before we look at the asset side, rather than the other way around.
Right. So is that one of the key reasons why, if you look at any QIPs, any public issuances that have happened in terms of QIP, banking stocks QIP have been successful versus most of the other sectors?
Yes, I think you hit the nail. That's exactly the point that I was trying to make, that the moment you have a QIP issuance in a bank, the bank stocks rally and then they stay put. That means they don't generally fall back to the pre-QIP kind of levels. But if you take the example of any other company which goes in for a capital issuance, then investors tend to fret about the dilution in the earnings. Okay, so in the case of banks, that is not that doesn't happen.
Right. Let's talk about aviation as a sector. Recently, SpiceJet has done well, Jet Airways has done well. Earlier, you have tracked aviation for really a long time. What has changed according to you?
No, I think what has really changed for the aviation sector is that oil has, for the last couple of years, fallen to very low levels or attractive levels for the airlines to really run their business. So that's point number one. Point number two, what has happened with the airline industry is they have grown their network massively. And that growth, although may have come with little lower levels of utilization in terms of passenger load factors, the asset turns, that means the aircraft utilization has grown higher. So what I'm trying to tell you is that the airlines have seen better aircraft utilization, lower load factors, lower yields in terms of pricing of average tickets, but this whole expansion in terms of volume growth. So if I were to equate the aviation sector with any other sector, then I would say volume growth has really helped.
The traffic growth that you're pointing out.
Correct. the volume growth is traffic growth for airlines.
Right. But, in terms of aviation, can you just tell us that, with the capacity expansion that has happened, we've seen such, numbers earlier, we've seen such companies posting such profits earlier. But, they tend to be very volatile, very lumpy in nature. One quarter is very good where oil is down, traffic growth is good. So do you see a sustained number, a predictability to this sector which is coming in, which was absent earlier, because of which the sector has re-rated?
I think the predictability comes because of the focus on cost. The airlines are now increasingly focusing on ex-fuel CASK, the cost per ASKM. And unlike the earlier years, the CASK is also crucially dependent on aircraft utilization. The moment you have an aircraft utilization below 9 hours per day or something like that, then the CASK would not, you couldn't as an airline company control your CASK. But the moment your aircraft utilizations are now like 12 hours or 13 hours per day, the CASK is substantially controlled, and therefore your ability to price your tickets in a rising volume growth or rising traffic growth environment, even if you price your tickets lower, you have that cost buffer available for you to make sufficient margins. And that to me is going to remain sustainably high or sustainable for quite a few months, I would say, or quite a few quarters now. So the predictability is increasingly coming in because of the high aircraft utilizations that we are seeing.
Right. Mahantesh, thank you so much for taking out time for us. Always good to get a perspective from you.